Hello everyone, happy Friday. I hope that you had a good time in the markets this week. I know that I did, always watching out for the next opportunity that happens to be out there. And while I definitely like the safer plays and the long-term investing, it doesn't mean that I won't take advantage of some short-term trading opportunities that happen to arise in the market. So I don't spend a whole lot of time celebrating, and I also don't spend a whole lot of time lamenting either, because eyes forward, eyes on the prize, and always looking for the next thing. I want to take a look at the markets this week and see how they did, talk a little bit about how I think that they're going to do next week. And I also want to take a look at three big movers that we saw this week and talk about what happens moving on from here for each of those companies. So that said, if you want to hear more of my commentary, see more of my product services, and also participate in my private Discord, the link for the Patreon is down in the description. Click it, come on over, sign up, visit us. We'd absolutely love to have you over there. Things are heating up in the conversations. We talked about a lot of different opportunities, a lot of different plays that I was making, that other people were making, and it's turning out to be a really good time. That's enough of that plug. Hit the like button, hit the subscribe button and notification bell. And with that said, I am Dr. Stock, Doctor of Education. Let's get right into it. All right, I like to kick things off by spying on the SPY. And, well, let's go all the way back here to October. What a run. Let's go over to January. So here we are. Actually, I'm sorry, that's December the 28th. January, there it is. On that big old red candle, January 3rd, the first trading day of January. And what a nice run that we've had. It was absolutely incredible to watch. A lot of our favorite growth plays, just the market in general, moving up in a way that it hasn't in a while has been a lot of fun. And the fact that we didn't have to set a new low on the way to get to some relative high that didn't beat out the past high. We are in a really good spot, generally speaking, for the markets. We have what looks a little bit like an inverse head and shoulders pattern happening here, which could be a good sign for us. Now, technical patterns are always trumped by economics that are happening in the background. And if it is about a particular security for a single company, then company news can also trump the technicals and it can squish it in a moment. We do have to pay attention to the Fed and how they plan to carry forward from here. Will they do 50? Will they do 25? How many will they do? Right now, I believe the market's pricing in 325 basis point hikes from what we currently have, from where we currently sit with the federal funds rate. And, it's already considered high. Jerome Powell already said that deflation is in the pipeline for housing, for services. It's just lagging and has yet to catch up. And he also said that inflation was not going to moderate quickly, that it was going to stay a little bit higher for a little bit longer than expected. So we're going to have to watch how that plays out in the markets. So here we're looking at the SPY. We've had some really nice run-ups since October. That's this big candle back here on October the 13th. That was a great day in the markets for us. And it was also a great run leading up to right about here, December the 1st. Good. And then we retraced for a little while, and 50% retracement is actually a really healthy amount of retracing, especially giving the bulls just enough time to really recharge and press forward. So coming back down to these lows that we saw here, and then allowing us for that run up that we got through January, through that time where recession fears, we kind of settled a little bit with the fact that the economy might slow down a little bit on us. Inflation fears, we kind of settled with the idea that inflation was likely moderating. And then, here we saw the CPI report come out and people were like, it's okay. And then we had Jerome Powell come out and say about disinflation, about the fact that it was in the pipeline for housing and services. And so the market was okay. And then PPI came out and, the market was a little bit less okay with PPI being hot like that. And as we get more reports like that, they keep on saying that inflation is still sticking around for us, and it's running hotter than expected, and the labor market remains tight, and retail came in much hotter than expected. As a matter of fact, some of the highest numbers that we've had, I think in 2 years, I'd have to go back and check that one, but I do know it's a very high print for retail sales. So the consumer is still showing very strong. That's not a good thing, which means that it leans on the Fed a little bit more, at the very least, to talk. And so that's what they did, was they talked possibly about that 50 basis point hike in March. Maybe we get it, maybe we don't. That actually leads me a little bit into next week looking at the Fed minutes that come out on February the 22nd, I believe that it is, and it's at 2 p.m. And that will be very telling for what they talked about in their previous meeting. And hopefully it gives us a little bit of insight into how they'll be thinking about, or how to think about, the summary of economic projections comparing to what we saw in December from the last SEP that came out. That summary of economic projections, SEP. From the last SEP that came out, talking about the target federal funds rate, about GDP expectations, and looking forward to March then at their next FOMC meeting, March 22nd and 23rd. When that summary of economic projections comes out, we want the Fed minutes from this coming week to give us any insight whatsoever that it can, based on what they've said and expected back in December to what they were seeing at the end of January into February, and then looking forward into March to anticipate what they're going to say. So Fed minutes could be very impactful in that way. We also have the second estimate of GDP next week. That second estimate for GDP is for Q4 2022. Right now, the advanced estimate has come in at 2.9%. We want to see for the second estimate as it comes out, did the economy cool off a little bit and we have a reduction in GDP? If we did, that could be a sign of economic slowdown, which might be a little bit more telling in terms of inflation. Really, we need to watch for what the consumer's doing, because that's also going to be helpful for us, which means that not only do we want to watch the second estimate for GDP was 2.9% about right for GDP for Q4. Was it too much? Was it too little? But then the PCE that comes out with personal income and outlays, we want to see more about the consumer, what they're earning, what they're saving, what they're spending. That's the next telling part that we have. So next week, we're not necessarily out of the woods yet with all this. We could most definitely test 4,000 in the S&P. We could possibly retrace below there to that 50% retracement level from the previous low that we had to start January. And that doesn't mean that the market is going to just fall to pieces. It is a healthy thing to happen. So I do want to move on from here, but I will say in summary, next week, sideways, probably down, especially with PCE capping off the week for us. I don't anticipate that PCE is going to be very favorable to us compared to what we got with the CPI coming out as hot as it did. And we might just see further evidence that would cause people to think, the market to think, that the Fed's going to have to be more aggressive than what they were at their last FOMC meeting when Jerome Powell came out and spoke following that meeting. So I did say that I would talk about some movers this week. And ChargePoint here was one of them that did move quite a bit, had a day where it moved up 10%, thanks to news on the EV infrastructure build out that the Fed is going to throw $7.5 billion towards. And ChargePoint is one of the companies that stands to benefit from that. So here's ChargePoint. I hold them in my portfolio, and we watched that run up take place. And that was a really nice run up. Like I said, they had about a 10% day, and people watch that big jump and they all want to jump into it because they have that confirmation, that certainty, like it's moving. Yes, I knew it. Buy. As in B-U-Y, not B-Y-E. I'm not saying buy to everybody. So at that moment, when it runs up that high, oftentimes at those big moves that we have, we want to take a look at the chart and see in the technicals where it's landing us and capping us off right at around $13.50. I'm just going to put that price out there for the moment because that's about where these both topped out. That's where these previous peaks happened, where we had the nice run up after trading sideways for a little bit. It peaked out, stalled, fell back down, peaked out, stalled, fell back down. So $13.50 running up to that point may not have been too surprising to anybody who is really following ChargePoint. So to buy in at that point would be buying in right at resistance. So starting a position there, a long position, hoping it to go up further, not saying it won't, because it definitely could. However, when you have exciting news about a company, but the fundamental value of the company hasn't changed, well, those prices often come back down after the euphoria is over. So we had that nice big pop we had yesterday in the markets that were red, where PPI came out rather hot. And then today we had another further drop in the markets and things settled back down. So let's zoom in. And where we opened on the day where we got the infrastructure news, We closed pretty much even. So, did you have to rush in and buy it? Absolutely not. As a matter of fact, in the markets, when you rush in and buy something and you're not really sure what you're buying or why you're buying it, more often than not, the market will take your money. There's a lot of smart people. There's a lot of smart machines. And they do a lot of this trading, and they watch for those moments to happen. Next up, we have Airbnb, and Valentine's Day earnings showed it some love because by the next day, this thing skyrocketed up. It had another good day after that, moving up almost from high point to high point, about 20%. Just absolutely incredible for Airbnb, and their forward guidance was strong for travel. So, kudos Airbnb. And when it closed now, if we take a look by zooming out a little bit more, you can see they've sputtered out here before rallying back up again. I think market bias is going to have to tell us a lot about that. And we want to hear more about the consumer to find out if travel demand is going to stay just as strong as they think it is. For me personally, I'm leaving Airbnb alone. I feel like I already missed the boat on this one. And you know what? I don't care. I don't care because as soon as I start caring that I missed it, then I start focusing on Airbnb that I missed, and I start missing all the other opportunities that await me that I would find if I was just looking for the darn things. So let's move on to one that I did find. So here's DraftKings, and DraftKings is one that I have a long position in my portfolio. And as earnings was coming up and knowing that the NFL season is a big season for them and they're in a growing industry of online sports betting, and the Super Bowl, I think, has been the biggest one yet, I figured that there was going to be a lot of positive news coming out of DraftKings. And I posted about it over my Discord. So if you want to check that out, link for the Patreon's down in the description. You can check that out. Come on over and talk with us. We'd love to have you. Moving on from there. So I was bullish on earnings. And so I put out a spread because just in case I was wrong, I want to protect the downside. What did that mean? It means that I only got 14%. Now, only 14% is, I would take 14% every day. When I say only 14%, people who took one-day options on that, one-day calls. Now, while they made a lot more money than I did, they also took on a lot more risk than I did. For me, if earnings came out differently than expected and that price dropped, well, then I still could have made money when it dropped because of the spread that I placed. So the spread, the only way to lose money on a spread is if the underlying security doesn't move enough. And I figured that this was going to be a big move based on the other earnings that I have seen, that things were either just absolutely skyrocketing because they were wonderful earnings with strong forward guidance, or they were dropping through the floor. And because they were making such big moves, and I figured that DraftKings would also make a big move because, I mean, they are getting to be a big revenue company, but they're definitely a big spend relative to their revenue. And, well, that can really rattle markets. Normally, earnings for DraftKings aren't taken lightly. Normally, there's a big move. So I placed a call put spread because I thought that would make that big move and I'd be profitable either way. Turns out this time I was right, and that was a nice thing. Watching it go up as much as it did, I slapped some Bollinger Bands on that thing, figuring that it would be above 2 standard deviations outside of the mean, and it was. And so I bought some put options, figuring that this thing would retrace a little, that it would settle back down from where it was at. Saw it run up, figured that that excitement wouldn't hold out forever. So I bought some puts against it, and I already sold to close some of those puts because, well, they had gone up, I don't know, 15, 20% since I had bought them, and I didn't want greed to get the best of me. 15 to 20% in a single day, I'll take that trade again. I'll take it all day. I'll take it every day. And if I did, I would be super rich super quickly. I don't win every time. I got burned on Airbnb. The name of the game is just being right more often than I'm wrong, and also protecting that downside. So with DraftKings, the spread worked because the underlying security moved enough. Woo! Also, the puts, watching it run up like it did, I was like, oh man, this thing's not going to stay here forever. So I bought some puts while the price was high, because then the price when it comes down is where you would make that money. There's a little bit of issue with volatility when it comes to options because it makes it more expensive. However, it worked out well for me. I don't remember what it was, 15 to 20%. So for DraftKings, glad I didn't get burned on this one. Glad I took advantage of the opportunity. I'm glad I was looking for opportunity. I'm glad that I found opportunity. 2 claps. All right, celebrating's over. Now it's time to look for the next opportunity. All right, guys, this video is getting pretty long, so let me summarize. Next week, sideways or down Those are the two things that I think by the end of the week is what we're going to see. If we do move to the upside, which I don't expect, I think we got about 2% to move to the upside throughout the 4 trading days that were open. PCE, I think, is going to be the biggest telling day that we have because it's one of the Fed's favorite tools to watch. And we want to see if it comes in hot, just like CPI and PPI did. And because it does have high correlation with the CPI, there's a good chance that that is also going to come in hot. And it might just cause the market to bite its nails. And, well, I just want you to be prepared for it, for whatever happens. And honestly, if it trades way up and I'm wrong, kudos to anybody else that are long positions and was counting on it being long, betting on it being long. I'm just trying to prepare myself as best I can. And in my preparation, I'm also trying to bring it to everyone here watching. So thank you for watching. I really appreciate it. Just remember the opportunities that you find, or, if it's too late, crap, it's too late. Learn what you can from it and move on. If you won, if you really made bank on something, congratulate yourself. 2 claps, move on, eyes on to the next opportunity. Just don't dwell one way or another on either one of those 2 things, because that will blind you to the other opportunities that could be taking place in the markets. And the same can be said for life. So thank you guys for watching this video. I really appreciate it. If you want to hear more of my commentary or see more of my products and services, please head on over to the Patreon. You can find the link for that down in the description. If you like this video, make sure you click the like button, please. Also subscribe to my channel if you would like to, and click that bell for notifications to see any time that my videos come out. I really appreciate the time that you've given me. I'm Dr. Stock, Doctor of Education. We'll see you in the next video.